a todos, muito obrigado pela sua audiência. Meu nome é Mariana de Biase, sou responsável por fundos internacionais aqui no XP. E hoje tenho a grande honra de estar ao lado do Rodrigo Sgavioli, Head de Alocação da XP, para um Expert Talks bastante especial, né? Hoje vamos falar de Asset Allocation e Diversificação Internacional com a Nanette Jacobson da Wellington. Let's now switch to English. Nanette, welcome to XP. Thank you so much for being here with us.
Thank you. It's a pleasure, and thank you for inviting me.
And thank you for the partnership. Wellington has been nothing short of an amazing partner to us.
I appreciate that. Thank you very much.
So Nanette here is a global investment strategist at Wellington Management. She's a well-respected thought leader at the field of multi-asset investing. And with her extensive experience and insight, Nanette provides Wellington clients with great insight around guidance in global macroeconomic trends and investment strategies for Wellington and for clients like us here at XP. So Nanette, let's start with an introduction. Why don't we talk a little bit about Wellington and the Wellington way of doing asset allocation, multi-asset investing?
Yes, sure. So Wellington is a unique asset management company. We manage around $1.3 trillion. 500 billion is equities and the rest is in fixed income. And what makes Wellington unique, the first thing is it's not a public company. It's a private partnership. And that gives us the ability to think very long term. We are not subject to analyst estimates and ratings and quarterly earnings. And so we can take a long-term perspective, both for our company, but mostly for our clients. And we can think long-term. So that's one reason that Wellington is unique. It's a private partnership. The second reason is that we have a saying, a mantra, that prioritizes clients over everything else. The mantra is client, firm, self. Think about the client first. As I said, as a private partnership, the only thing we do is manage assets. And in managing those assets, we take a long-term view for the client. And what guides everything that we do, when we ever have to face a decision, what guides us is what's best for the client. We have no other interests in terms of positioning our own capital or any competing interests. The only thing that we do is run assets for the benefit of our clients. The third thing is that we do not have, like most asset managers, we do not have a chief investment officer, or what we say CIO. And the reason is deliberate. We think we as a firm are better at delivering alpha and delivering excellence without a chief investment officer. At most asset management firms, the chief investment officer sets the strategy for the entire firm. And so that may be correct or it may be wrong. Instead, at Wellington, we think a better way to run assets is to have an environment of debate. So no single person has a call on what's going to happen in the economy, what's going to happen to assets. We centralize research. We have experts in every field, in every asset class, in every region, all over the world. And then the portfolio manager of each team takes that as input and decides what's the best strategy for their clients. So we have many CIOs, not just one.
And when thinking about the Wellington way of thinking about multi-asset investing, can we talk a little bit about how your team is constructed and how you're looking at portfolio construction?
Yes, sure. So multi-assets are one of the areas that we have. We have around $55 billion in assets under management. I am part of the decision-making process. So the strategists at Wellington actually are implementing their views in portfolios. Another distinction between other asset management firms. So I take what I analyze and what I say very seriously, because it really does translate into returns for our clients. The philosophy that we have in the multi-asset team is the first question we ask clients is, how much risk do you want to take? And this forms the basis of our strategic asset allocation. That's the allocation that will last for many, many years, maybe 5, 10, 20 years. And depending on the risk objective, how much volatility the client wants, we will translate that into a mix of stocks and bonds. So if it's a client who wants very low risk, we might say, okay, you should have 70% in fixed income and 30% in equities. Conversely, if it's a client who wants more volatility, then we would flip that and say, let's start with 70% equities and 30% fixed income. Now, that's too simple, though. And a strategic asset allocation that only includes stocks and bonds is really not sufficient. We think about other asset classes that will perform well if equities don't perform well or fixed income doesn't perform well. So a portfolio that will deliver positive returns in various economic environments. So that's step 2. Step 1 is a simple allocation, equities, bonds. Step 2 is a more thoughtful allocation that takes into account different economic scenarios. So in that step, we will include things that are inflation sensitive. As a firm, we do think that inflation will be structurally higher in the years to come, higher inflation over the next 10 years than the previous 10 years. So you want to include inflation sensitive assets. Another thing that you would want to include is credit. Credit is different from government bonds. You get a spread for the risk you take. It could be corporate bonds, could be emerging market corporate debt. It could be structured finance, mortgage-backed securities. There's so many different types of structured credit or credit that gives you a spread, some number of basis points over treasuries. So we would include credit in this strategic asset allocation. And then we're going to look at 2 more things, themes. There might be themes we think that are going to last 5 to 10 years. Maybe it's artificial intelligence. Maybe it's biotech. Things where innovation is going to play a transformational role in the economy or the world. And then finally are alternatives. And alternatives are, again, they could be many different asset types. Hedge funds could be taking advantage of macro volatility. It could be hedge funds that take advantage of long, short opportunities in European equities or US equities. It could be absolute return, where you deliver an absolute return regardless of the environment, something with no beta exposure, no market exposure. Many, many different types of alternatives, but we think a small allocation to alternatives is appropriate. And then that's step 2. Step 3 is to give bands around the strategic asset allocation to do active asset allocation. So the strategic asset allocation has a 5 to 10 year time frame, and then the active asset allocation has a 12-month time frame.
I see.
And the active asset allocation would be more focused on what's happening to the cycle, what's happening to central banks, what's happening to politics, policy, geopolitics, and how should we adjust the portfolio more overweight, less, more underweight based on what's going on over the next 12 months. So those are the 3 steps.
Perfect. Nanette, very insightful. So let's bring this conversation to Brazil.
Yes.
From a Brazilian standpoint, let's talk about international diversification, okay? Because here in Brazil, we have a problem that most of the clients, most of the investors are just focused on fixed income investments.
Yes.
Part of this because of the interest rates that are very high, historically very high here in Brazil. And the other part is the lack of knowledge about the diversification benefits that we can bring in a long-term perspective. So due to that, given your experience, what should you recommend to a Brazilian investor, even to a Brazilian advisor, for example? What should we do? What are the steps to start diversifying portfolios or bringing another asset classes to complement the fixed income strategy that we have to most of Brazilian portfolios?
Yes, so I think that the first thing is to really look and understand what the volatility of the Brazilian assets and the currency are, because it's possible that clients don't know how volatile the currency is. And so even maybe how volatile cash rates are. So I looked at the volatility of the currency, and the currency is twice as volatile. It's about, over the past 6 months, it's been about 15%. So 15% volatility relative to the dollar, which has half that volatility, so 8%.
And most of the clients think that the volatility comes from the dollar, not from the BRL. Yeah.
Yeah. So I think the first thing, and I always say this, markets, you have to be a student of the markets. If you're going to be in finance, whether you're a client, you have wealth, you need to be educated. You need to understand what the concepts are for you to have rich conversations with your advisor and understand how to grow your wealth in the best way. So I think understanding volatility is really important. Now, on high cash rates, obviously 11.5% is very attractive. Real rates, I think, right, 6-7%, something like that. So it is very attractive. But again, can you, over the investment horizon of the client, what would you say is the typical or the investment horizon of a client? Is it 6 months? Is it 1 year? Or is it 3 years, 5 years, 10 years? I think if their investment horizon in 10 years, you can't count on 11.5% rates.
That's it.
In the United States, we face a similar challenge. Everybody is in cash right now. But as yields are coming down because the Federal Reserve is cutting rates, they realize they're not going to get that 5% much longer. So our clients are moving into equities or fixed income. For a Brazilian allocator, for a Brazilian client, I would suggest that the first step is to get exposure to US equities. You get diversification in two ways. The Brazilian equity market is concentrated in financials and commodities, right? And energy, metals, all of these things. That is most of the market.
The old economy, that's it.
Yes, yes, and that's fine. But again, you know, whatever happens to oil prices or whatever happens to financials because of how the central bank is moving, you have one bet on. Now, what is the concentration in the US equity market? The exposure is to tech, 30% of the market, and the next biggest is financials. So you have financials exposure, but it's very different from Brazilian financials. So the most important thing is that you get sector diversification in tech, very important for the future. We said thematically, we think artificial intelligence is going to be full of innovation and money-making ideas. So you want exposure to tech, and then after financials is healthcare, industrials, you know, all the sectors, and more consumer discretionary, communications. And remember, communications is also part of the tech sector.
Perfect.
Yeah.
You know, and consumer discretionary is also the tech sector.
And then even if we talk about artificial intelligence, it is permeating a bunch of different sectors, because when you look at the performance of the utilities this year, for example, it's very much related to the AI.
Absolutely,
But
yes.
not in the Brazilian market. in
the US market, yes.
Yes. So for utilities, I'm glad you brought that up. All the conversations at Wellington is how will data centers get power?
Yeah.
So there are a range of companies, including the hyperscaler tech companies that are either they're buying nuclear power, utilities are figuring out ways to deliver more power. There are going to be opportunities in solar energy because the needs to power data centers so far outstrip the supply right now that you will have many industries involved in utilities, nuclear power, solar power, electricity, that are all going to be involved in supplying that power. Yeah. I want to just finish one more thing. So you get sector diversification by being in US equities, and then depending on whether you want the dollar currency exposure, I think it makes sense to have diversification of currencies, because you could have a situation where equities go down and the dollar goes up, or the real goes down and the dollar goes up. So that is a natural hedge, and every time you have asset classes that move in different ways, you cut down on the volatility of the whole portfolio. So this is the one concept in portfolio construction that is so important. And we say in the United States, diversification is the only free lunch. You pay for everything else. But if you diversify, that is one thing that you get for free, because you lower the volatility for the same return. Or since you lower the volatility, you can use that volatility to buy something more risky.
Perfect. That's it.
Now, Nanette, let's start a trip around the world across asset
Then let me
classes.
take a drink first.
Please. Starting with fixed income. So after years of super low interest rates, we could say that bonds are back. Yields are quite high, but spreads are a little bit compressed. Can you talk a little bit about this dynamic between yields and spreads, and how your team is thinking about that dynamic when constructing fixed income portfolios?
Yes. So let me start with the government bond market. As you said, in 2020, when COVID hit, we were essentially at zero interest rates around the world. Then there was an incredible recovery plus stimulus once we passed through that period. And in 2022, we had inflation all over the world because of the recovery, because businesses were recovering, consumers were spending again, and there was so much stimulus. Yeah. Governments were giving money to consumers. So that generated inflation, and the peak of inflation in the United States was, depending how you measure, it was 9%. So the Federal Reserve became very active. Mm-hmm. They hiked interest rates by 550 basis points. So the policy rate went from 0 to 5.5% in a very short period of time. It was really unprecedented. At that time, spreads, so let me just, again, to level set, you can buy government bonds at a particular rate, but if you want to take a little risk in the corporate bond market or high yield market, you get a certain amount of interest rate above that. So in high yield, for instance, you get the treasury rate plus you get an extra percentage for the risk in the high yield market. So what has happened since the recovery after 2000, really it started in 2023, spreads started at very high levels and they keep narrowing. Mm-hmm. So the demand for credit, the demand for spread over government bonds has been tremendous. So now spreads from a valuation standpoint are quite tight. Mm-hmm. Despite that, in our multi-asset portfolios, we are still overweight credit. And the reason is that yields are still relatively high. So last week, the 10-year yield was 4.5%. And high yield is, it's about, let's say, 250 basis points. So you get 7% in high yield. For most investors, Asian investors, European investors, in Japan. That's a very attractive yield. And what we're seeing is that the default rate for these companies is actually very low. So I think that spreads could stay narrow for a long time. And that's why we still you don't want to have a big overweight in credit, but a small overweight I think makes sense.
Perfect. Let's talk about interest rates around the world.
Okay.
Yeah, because they're starting to coming down.
Yes.
And mostly in the developed world like US, Europe. And the question here is, what about, it's time for the average client here to start taking some more risk in their portfolios.
Yes.
In the fixed income market, in the risk assets. What do you think about, should this movement in the interest rate, should like be a driver for us to take some risk in the portfolios?
Yeah, I think it's not only interest rates, it is the economic backdrop. So we have growth in the United States in the third quarter, GDP came in at 2.8%. So most economists thought that the growth in the US would be between 1 and 2% in 2024. It has surprised to the upside. So growth is good. Inflation has been coming down from 9% at the peak to 2.5% now. And as you said, Fed policy and many central banks around the world are cutting rates. And one more thing, productivity has been going up in the United States. It's actually much higher today than it was the last 10 years. And
Due to AI, you think?
I think it's coming from technology.
Okay.
Yeah, the world has been waiting. Where will the productivity gains, when will they come? And we are seeing in this past year, the productivity is higher than it had been. You can imagine that the use of artificial intelligence will only propel that further. The reason I'm saying this is because even without Fed policy, we have a positive backdrop for risk. So I think that the first move, if clients are looking to make a change, I do think getting out of cash and going into equities, whether it's global equities, US equities, something that's diversified, and something out of local currencies I think the environment is good for that.
The no recession scenario, like it's good for those assets.
I mean, it's, all of 2023, what were we talking about? When is recession? When is the recession coming?
And how many cuts are we going to get?
And how many cuts? What the worst call of a century. So we've had a didn't come. I mean, it seems like the Fed achieved the dream of the soft landing.
Yeah.
No landing.
Or no landing.
No landing for that matter.
Yeah. But it's very good. I have concerns. If you'll ask me what the risks are, and we can talk about that. I think there are risks out there, and I have things that I look at that I will share, that everybody can look at to see how the market is assessing that risk. But for the next 6 to 12 months, I think things are pretty good.
The comfort of the money market funds, they are not the same right now, for example.
Yeah. No, I mean, the risk is on the fiscal front in the US. And when will the market protest how much debt the United States has?
Perfect.
And it's interesting that you mentioned US equities, because the general pushback that we've had with US equities this year, last year, 3 years ago, 5 years ago is US stocks are expensive, maybe I should wait for a better time to come in, valuations are high, they keep going up.
Yes.
What are Wellington's perspectives on stocks for next year and for the longer haul?
Yes. So I think valuations are a useful input, but they should not drive your decision on allocation. The US stock market is around 23 times 12-month forward PEs, which is definitely on the rich side. Certainly over the next 12 months, I wouldn't use valuations as a guide to total returns over the next 12 months. We do use valuations more heavily in our capital market assumptions, which are 10 to 30 years. In those assumptions, we do assume that there will be some mean reversion of valuations to the mean. Therefore, over 10 years, we don't have very high expectations of equities. They are lower, mostly because of valuations. However, over the next 1 to 2 years, I remind people that the S&P, the U.S. equity market, is unusual. It's so concentrated in 5 stocks, 3 stocks, 5 stocks. And those stocks are 33 times on average. Very high multiples. But if you look at the U.S. market on an equal weighted, so every sector has the same weight, then the market is not 23 times, it's 19 times. And that's because sectors outside of the tech market are cheaper. We have a view that we like the tech sector, but we think that there will be a compression in earnings, that the earnings of the tech sector will start to come down. They'll still be good, but they're not going to exceed expectations, and the earnings of the rest of the market will come up. So broadening of the equity market rally, which is a really good thing for, it's a really good thing for active managers, because it's very difficult to overweight tech if you're benchmarked to the US equity market. So if earnings of the rest of the market, and that is what's been happening, is that actually the equal weighted index has been outperforming the cap weighted US market.
Okay, we've just had an election in the US where
No,
Donald Trump got
really?
elected. Yeah.
I didn't know that.
We have and we are moving towards to a red sweep with the House of Representatives. That is not decided yet.
Yes.
But the Senate, it's red too.
Yes.
So with that said, from an asset allocation standpoint, how this could impact in your decision in the asset allocation strategy? How does it impact your views from the world in the next years that is going to come, 4 years to come?
Yes. So I think that we have to think about investing from a political standpoint in phases.
Okay.
And the first phase is what we know. The first phase is that Trump will be our next president. He won the popular vote, and he has we think he has a Republican sweep. So he has a mandate.
Perfect.
Right? And we know what the 4 pillars of his strategy are. The 4 pillars are trade, taxes, regulation, and immigration.
Deregulation?
Deregulation.
In this case, yeah.
That's it.
And de-immigration, I don't know.
I don't know.
But those are the 4 planks of what he wants to do. We know that the stock market is up a lot, that small caps are up, that the dollar is up, cyclicals are up, and gold is down, and many EM currencies, some are up, some are down, but a lot of currencies are down. So I think that the next question is, what is the difference between the rhetoric and the reality? Trump I heard this morning, he has 4,000 positions to fill.
Wow.
So just staffing, he'd already picked his chief of staff, his deputy chief of staff. That's good. Compared to 2016, I don't know if you remember the chaos, but it took so long for him to get those positions filled.
He was not expecting to be elected.
No, and right, they were completely disorganized.
And even markets behaved in a very different way from what was expected of his win.
Yes.
That's it.
Yeah. So I think also the reason stocks are up so much is that, the economists, again, they got it all wrong. They said that it was going to be a very close race, and that if there's a Republican sweep, the stock market's going to drop. So a lot of the rally is also, I think, technical in nature because investors were positioned very neutral. Okay, so phase 2 is seeing who the staff is and then being very careful about policy and what policy is. Because right now the market's just responding, big broad brush. Small caps are going to do great. Well, what if interest rates are 5%? Are small caps still, companies with no earnings, are they going to do great? No. What if tariffs on China are not 60%, but they're 20%, right? Which companies have most revenues coming from China, which are coming from Europe? To what extent can those companies move their supply chains to different countries? What I'm saying, Rodrigo, is that you have to have very deep analysis of the sector, the policy, how it will affect the sector, and how it will affect each company. And for that, you need deep research and active management.
Great. Mari?
Nanette, I've got one more question for you. Over the last few years, we've seen the proliferation of the use of alternatives in portfolios and even more important, access opening up for non-institutional investors. How do you look at the use of alternatives as a way to make portfolios stronger from a multi-asset perspective? And how do you look at this democratization of alternatives for non-institutional investors?
Yes, it's a great question. We see that trend among our institutional clients. The biggest moves have been, they've been out of many public markets and into alternatives and private markets as well. Yeah. So I think that let's go back to the fundamentals. We're at a very interesting point in financial history. And I talked about inflation as a possible risk.
Yeah.
I think that the election results do bring that to the foreground in the United States because you have deficits of $1.8 trillion. Debt to GDP is 100%. We only have seen that debt during World War II and during recessions. So, and I think we see all over the world that the impulse to spend, to use fiscal policy as a way to fund different programs, et cetera, could mean that, as I said, that inflation over the next 10 years could be higher than we've experienced in the past 10 years. Mm-hmm. So the reason I think there's a place for alternatives is because we may be seeing much shorter cycles. It used to be that an economic cycle was 8 years long. I mean, what we've experienced over the past 10 years, how many cycles? I think we've had like 3 or 4 cycles.
Yeah.
And partly it's the speed of information flow, right? When news flows in a second, right? It's all over Twitter, social media, et cetera. Information moves so quickly now. Markets react, and central banks react. So if you're in an environment where you have shorter cycles, more volatility, there is a place for alternatives that give you a steadier ride. Yeah. A steadier ride in the standpoint they have more flexibility. Instead of being overweight or underweight, they can go long and they can make money by being short. And of course, alternatives is a huge market. There are hedge funds, there's private equity, all different with different volatility. But I think it's a great area to explore because having a lot of just pure risk in your portfolio can give you a headache and a stomachache. So
Yeah.
to have more assets that give you stability, that lower the volatility of your portfolio and give you a steadier ride, everybody wants that.
Yeah.
So I think the democratization of alternatives is a good thing. I think, though, that clients have to be aware of liquidity and how much liquidity they need. And this has to be an explicit conversation with the advisor. Because, of course, with many alternatives, you have much lower liquidity. You can't get your money back the next day. So that has to be a part of the education process.
Agree 100%.
Maybe the alts can make a role in the portfolios that protects from inflation, the level of inflation and the volatility of the inflation,
Yes.
isn't it?
Yes, yes,
Yeah, that's it.
absolutely.
Perfect. For me, the last question, Mari and Nanette, as an allocator, I would like to know your views on active and passive investments. How do you combine them in a portfolio? Like we have here in Brazil, like the ETFs, even the
Yes.
global market. And what about active managers? How do you manage both
Yes.
to construct a portfolio?
Yes. Well, I think there's a place for both. I think that you can use passive, and there are places that are better in the active world. What we do with institutional investors is we may use ETF for an asset class that's extremely efficient, and it's very cheap to use an ETF. But there are other styles of equity management that really require more research. I was talking about small cap as an example. Small cap, you better be careful that you don't just invest in the Russell 2000, because some companies have no earnings.
Perfect.
Some companies have floating rate debt, and some companies have earnings. So you want to be very judicious about which companies you buy. The other reason I think active is very important right now, even for large cap equities, because I was going to say in the past we have used ETFs as a replacement for large cap, but I wouldn't do that now. And the reason is that US large caps are very concentrated right now, 30% in the tech sector. So if that were to continue, then passive is all you need. But I don't think that's going to happen. As we've seen, some tech companies have gone up, some tech companies have gone down. And referring to what I said at the beginning, the earnings of the non-tech sectors are actually getting better, whereas expectations for the tech companies are deteriorating. So from that perspective, you want to be an active manager who is in those other sectors, in energy, in financials, in healthcare, in utilities, the sectors, Mari, that you were talking about, because those have begun to perform better. So I think it's a good environment for active, even in large cap. And then, of course, in the more esoteric sectors and emerging markets and small cap, these are areas that are less liquid and there's more idiosyncratic risk, and an active manager can take advantage of that.
Okay, but there is a place for both.
I think so.
Okay.
Yes.
Thank you so much. I think we're done.
Yeah. Nanette, it's been such a pleasure, such a great conversation. I think we could talk here for hours about each of the questions that we did here.
That's it.
And that's how great conversations are made. So thank you so much for your time.
It's my pleasure. Thank you so much for having me.
And thank you for the Wellington partnership, Sgavi.
Yeah, it's an
It's
honor
been
to
an
have you
honor.
here. Hope to see you soon here in
Yes,
Brazil
I
again.
hope so. That would be great.
Obrigada a vocês da audiência e até a próxima.